90% of retail traders lose money. Why? Because they are buying when they should be selling, and selling when they should be buying. They are chasing price while the smart money, the institutions, the banks, are the ones moving it. So how do you stop chasing and start anticipating? You master the oldest law on earth, supply and demand. Welcome to the Supply and Demand Trading Masterclass. My name is Ganesh, and in this video, I am going to completely change the way you look at a price chart. We are going to strip away the noise, forget the lagging indicators for a moment, and learn how to identify the exact zones where the big players are entering the market. By the end of this video, you will know how to draw zones like a pro, how to spot the difference between a continuation and a reversal, and most importantly, how to place your trades with surgical precision. If you are tired of guessing and ready to trade with an edge, hit that like button, subscribe to the channel, and let's dive into the masterclass. Chapter 1. The core concept. The why. Let's start with the absolute basics, because if you don't understand the why, the how won't matter. Supply and demand is an economic principle, but in trading, it's the footprint of the institutions. Think of a physical market, like a fish market. If there are tons of fish, supply, but very few buyers, low demand, the seller has to lower the price to get rid of the fish. That's a price drop. Now, if there are very few fish, low supply, and hundreds of buyers, high demand, the buyers start bidding against each other, driving the price up. In technical analysis, we aren't looking at fish. We are looking at massive orders. When a bank wants to buy $1 billion worth of an asset, they can't just click a button. They would drive the price up too fast. So, they wait for the price to come to a specific area where they can soak up all the selling pressure. These areas are our supply and demand zones. They are the footprints of the big boys. Our job as retail traders is not to predict the future. It's to identify these footprints and piggyback on the institutional move. Chapter 2. Identifying zones. The how. All right, enough theory. Let's open the charts and find these zones. This is the part where most traders get it wrong. They draw zones on every little wick and end up with a messy chart and losing trades. We are looking for structure. There are 4 types of zones we care about. But to find them, we look for one specific thing, the base or consolidation. Number 1, the rally base rally, demand. Here's the setup. Price starts rallying up. Then it stops and trades sideways for a period. This sideways action is the base. It represents the institution accumulating, buying. After the base, price explodes higher in a strong rally. To draw the zone, we look at the very first candles of the base. We want the origin of the move. I draw my zone from the high of the first candle in the base to the low of the last candle in the base. But remember, this is a demand zone. Price is likely to return here to find buyers again. 2. The drop base drop, supply. This is the exact opposite. Price falls hard, drop. It pauses and grinds sideways, base. Then it collapses again, drop. That base is where institutions were offloading their positions, selling. We draw the zone over that sideways base. This is now a supply zone. If price comes back up to this area, we expect it to act as resistance and push price back down. The freshness rule. Not all zones are created equal. We want fresh zones. A zone that was created last week is far more powerful than a zone created 6 months ago. The institutions remember where they left their orders, and they will defend them. Chapter 3. Entry models. The when. So, you've drawn your zone. Price is approaching it. Do you just hit buy or sell as soon as price touches it? Absolutely not. That's how you get stopped out. We need confirmation. We need an entry signal. I use 3 specific entry models. Model 1, the aggressive limit entry. This is for the experienced trader. You set a limit order inside the zone and wait. The risk is that price might blast right through the zone. The reward is that you get the best possible price. I only do this if I see a strong reaction on the lower time frames, like a clear reversal candlestick pattern. Model 2, the conservative breakout entry, my favorite. Look at this. Price drops hard into a demand zone. It doesn't bounce immediately. It sits inside the zone, creating small, quiet candles. This is called reaccumulation. The entry is not at the bottom. It's when price breaks above that small sideways range within the zone. This confirms that the sellers are exhausted and the buyers are now in control. Model 3, the flip zone. Sometimes a strong supply zone gets broken. When price retests that broken zone from above, it often acts as new demand. This is a powerful concept called role reversal, or a flip zone. Chapter 4. Money Management and Risk. You can have a 90% win rate, but if you don't manage your risk, one bad trade can blow your account. Supply and demand gives us the cleanest levels for stop losses. Where to place the stop loss? When you enter a trade based on a demand zone, your invalidation point is if price closes below the zone. That zone is the line in the sand. If the institutions are still buying, they will defend that level. If they aren't, the zone is broken. I place my stop loss 5 to 10 pips, or cents, below the demand zone, just to give it a little breathing room from market noise. Where to take profit? This is where many supply and demand traders struggle. They hold for Moon or Lambo, and they watch profits turn into losses. I use the risk to reward ladder method. Target 1, 50%. Take partial profits at the nearest supply zone. Target 2, 100%. Take more profits at a major structural level. Target 3, runner. Let the last portion ride with a trailing stop. Remember, the market moves from demand to supply and supply to demand. Your job is to connect the dots. Chapter 5. Common Mistakes and Examples. Before we wrap up, I want to show you a chart and point out the top 3 mistakes I see traders make with this strategy. Mistake number 1. Drawing zones on the 1-minute chart. The lower the time frame, the more noise, the more false signals. I primarily use the 1-hour and 4-hour charts for my zones. I only use the lower time frames like 5-minute or 15-minute for my entry precision inside the zone. Mistake number 2. Zones that are too big. If your zone is 500 pips wide, it's useless. A good zone is tight and defined. It shows that the battle between buyers and sellers was brief and decisive. Mistake number 3. Forcing the trade. Just because price is approaching a zone doesn't mean you have to trade it. Wait for the setup. Wait for the confirmation. Patience is not just a virtue in trading, it is a requirement. We have covered a lot today. We've gone from the psychology of why institutions leave footprints, to the technicals of how to draw zones, to the execution of entries and exits. Supply and demand trading isn't a get-rich-quick scheme. It is a skill. It requires practice. It requires you to sit in front of the chart, draw zones, watch how price reacts, and journal your trades. If you got value from this masterclass, please smash that like button. It really helps the channel. Comment below. Do you prefer trading supply zones or demand zones? I read the comments and I want to know. Thank you for watching. Stick with the process and I will see you in the next video. Happy trading.